This course is Financial Management. My name is Kirby R. Cundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this lecture, we will use the text by Brigham and Davis, Intermediate Financial Management, which is an excellent financial textbook. In today's lecture, we will cover Chapter 6, Accounting for Financial Management. Topics included in this chapter are how to read an income statement, a balance sheet, a statement of cash flows, how to determine free cash flows. We will look at some performance measures, although we will look at more of those in the next chapter, and we will give a brief introduction to both corporate and personal taxes in the United States. Throughout this textbook, we will be looking at the formula of how to value a company. One of the components that goes into that are the free cash flows each year. Most of this chapter will be related to how do we determine those free cash flows. Here is an income statement for a hypothetical company for the years 2014 and 2015. The top row is sales, and we can see in this case the company's sales went up drastically from 2014 to 2015. As did its cost of goods sold and other expenses. And finally, so did its depreciation. Depreciation is different from the other expenses because it is not a cash flow, it is an estimate of the decrease of value of the property owned by the company. To get the total operating cost, we take cost of goods sold plus other expenses plus depreciation. And to get earnings before interest and taxes, EBIT, we took sales minus the total operating cost. Finally, after that, you subtract the interest expense to get the pre-tax earnings. This textbook assumes corporate taxes are at 40%. They're probably a little bit lower than that since Trump cut corporate taxes. Now, this would be both the federal plus the state income taxes. You subtract out the taxes from the pre-tax earnings to get net income, which was positive in 2014. When looking from 2014 to 2015, net income went negative, and this was due to the massive expansion the company engaged in. Cost of goods sold went up, other expenses went up, depreciation went up, so earnings before interest and taxes went down, interest expense went up, so pre-tax earnings went down significantly, and companies are allowed to write off current losses against past taxes paid, which means if they made enough income in the last 2 years, they could get back $63,424. In summary, we could say sales increased by over $2.4 million, but costs shot up more than sales, so net income was negative, and the firm received a tax refund, again, of $63,000 due to the carry forward provisions of the tax code. Now we will look at the balance sheet. We can see expansion in the balance sheet as well. Cash went down. We will show that that was to pay for the expansion. Short-term investments went down, also to pay for the expansion. But accounts receivable went up as the company is expanding and selling more stuff. Then the people that are buying that stuff will owe the company more money. Similarly, inventories went up drastically as the company expanded and produces more items. Total current assets, therefore, went up drastically since the company needs more assets to operate as an expanded company. Gross fixed assets also went up drastically, factory, plant, and equipment, as they expanded to produce more stuff, and the depreciation of those fixed assets went up, so net fixed assets has increased drastically, and total assets has increased drastically. On the liability side, we will soon look at how they financed that expansion. So in summary, we can say net fixed assets almost tripled, accounts receivable and inventory doubled, but cash and short-term investments fell to finance this expansion. So our liabilities and equity, well, accounts payable went up quite a bit. If you sell more stuff, you will finance people to buy that stuff. Notes payable went up drastically as they borrowed more money to finance their expansion, and accruals went up. The difference between accounts payable and accruals: accounts payable is external, and you are loaning people money short-term to buy your stuff. Accruals would be internal and would be money that you owe perhaps in taxes for the next quarter, or in a 2-week or 1-month period, money that you owe employees for paychecks. So the total current liabilities went up drastically. They borrowed notes payable short-term debt and long-term debt to finance the expansion, which went up drastically. They did not issue any more stock, and they lost some of their past retained earnings through paid out dividends and also through losses as they paid for the expansion and hopefully will become profitable in the future. So the total equity, which is the common stock plus retained earnings, and the company went down, but total liabilities and equity went up drastically. In summary, the current liabilities increased as creditors and suppliers financed part of the expansion. Long-term debt increased to help finance the expansion. They didn't issue any stock, and retained earnings fell due to the year's negative net income, and as we will see, a dividend payment. When calculating cash flows, net income is a good starting point, but you need to put a lot of adjustments to it. The first one is depreciation. So net income was negative, but you add back in depreciation, because depreciation is not a cash flow. It's merely an estimate of the decrease in value of your factory, plant, and equipment. Accounts receivable was a negative cash flow because as our company expanded, it needed to finance more people buying its stuff. Inventories is also negative because as it expanded, it needed to buy more stuff to sell. Accounts payable, on the other hand, is a positive because as it expanded, it borrowed more from its suppliers, and that helped offset some of its other negative cash flows. Also, change in accruals is a positive. As it expanded, it hired probably more people, and therefore it owes more in estimated taxes, in estimated 403B payments, and in things like estimated healthcare costs. At the end, we had the net cash provided used by operations, which is the sum of all of these items, both positive and negative, and we end up with a negative $503,936. And of course, that cash has to come from somewhere, and it comes from investing activities. So if we look at investing activities, we look at cash used to acquire fixed assets. We needed another total $711,950 in fixed assets. Change in short-term investments offset some of that because we sold some of our short-term T-bills and commercial paper and gained $28,600. So the net cash provided by investment activities was $683,350 that is used to finance our expanding operations. Financing activities, well, we also increased outstanding notes payable and borrowed another $520,000 short-term. We also increased long-term debt and borrowed another $676,568 long-term. Even though we were losing money, we paid out a dividend of $11,000, which is very common to make sure your stockholders that are counting on that are happy. So that is a negative. Summing all these up, net cash provided by financing activities was $1,185,568. So the summary of our statement of cash flows: net cash provided by operations was negative $503. Net cash to acquire fixed assets was negative $683. Net cash provided by financing activities was $1,185,568. So the change in the net cash on hand, netting all this out, our cash decreased by $1,718. At the beginning of the year, we had $9,000 in cash on hand. Now we only have $7,282. So our conclusion from the statement of cash flows is net cash flow from operations is negative $500,000 because of negative net income and increases in working capital. The firm spent $711,950 on more fixed assets, and the firm borrowed heavily and sold some short-term investments to meet its cash requirements. Even after all of the borrowing, its cash fell by $1,718. So in summary, what is free cash flow and why is it so important? Free cash flow is the amount of cash available from operations for distribution to all investors, including stockholders and debt holders, after making the necessary investments to support operations. A company's value depends on the amount of free cash flows it can generate in the future. So if you get free cash flow, what do you use it for? Well, you have debt outstanding, you got to pay interest on it. You might pay back some of the principal on the debt. In the case of this company, they're not doing that, they're getting more debt. You could pay dividends. You could also buy back stock, which is very popular among the bigger companies in the United States now. And you could also buy non-operating assets, marketable securities, investments in other companies, commercial paper, etc., which are short-term liquid investments companies sometimes engage in to add liquidity beyond the cash on hand with something that at least pays some interest. We can summarize by looking at this graph on how to calculate free cash flow in 5 easy steps. You start by getting EBIT, or earnings before interest and taxes, off of the income statement. Multiply that by 1 minus the tax rate to get net operating profit after taxes. Then you look at net operating working capital, which is operating current assets minus operating current liabilities, both of which have increased drastically in the example of our firm. Then you take net operating working capital and add to it operating long-term assets, which have also increased drastically for our firm. That gives you the total net operating capital. Then you take the total net operating capital this year and subtract the total net operating capital last year from it to get the net investment in operating capital. If we take the net operating profit after taxes and subtract from it the net investment in operating capital, what is left over is the free cash flow. In our particular company, We can start by, again, looking at the net operating profit after taxes, or NOPAT, which is defined as EBIT, earnings before interest and taxes, times 1 minus the corporate tax rate. In 2015, our EBIT was 17,440 times 1 minus the 40% corporate tax rate, which again is now somewhat lower since Trump cut corporate taxes, to get NOPAT in 2015 of 10,464. Identically, we would calculate NOPAT in 2014 as 125,460. So NOPAT has gone down drastically, again due to the expansion. Next, what are operating current assets? Well, operating current assets are the current assets needed to support operations. They include cash, inventory, and receivables. They exclude things like short-term investments because these are not a part of operations. They are just a way of providing liquidity beyond cash. Next, what are operating current liabilities? Operating current liabilities are the current liabilities resulting as a normal part of operations. They would include accounts payable, money you owe to other companies, and accruals, money you owe to the IRS, your employees, or insurance companies. They would exclude notes payable because this is a source of financing, not a part of operations. To get net operating working capital, or NOWC, we will take operating current assets minus operating current liabilities. Looking first at 2015, our operating current assets of cash plus accounts receivable plus inventories are 7,282 plus 632,160 plus inventories of 1,287,360, and our operating current liabilities are accounts payable of 324,000 and accruals of 284,960. Taking the operating current assets minus operating current liabilities, we get NOWC for 2015 of 1,317,842. We do the same calculation for 2014 and get 793,800. Again, NOPAT has drastically increased from 2014 to 2015. Our total operating capital is NOWC plus net fixed assets. Our operating capital, therefore, for 2015 is what we just calculated of 1,317,842 plus the net fixed assets of 939,790, giving the operating capital for 2015 of 2,257,632, a large increase from 2014 of 1,138,600. Free cash flow is NOPAT minus net investment in operating capital. Our NOPAT for 2015 was only 10,464, and we had a huge increase in the net investment in operating capital. The difference between 15 and 14 of 1,119,032. So our free cash flow was negative 1,108,568. This free cash flow, of course, had to be financed by more borrowing and other financing activities. So how do you suppose investors reacted to this? Investor reaction will depend on whether or not the investors believe the massive expansion will pay off in the future. And we will study that in the next video on the second half of this chapter on accounting for financial management. I thank you for watching this video.